Hello, everybody, and welcome. This is my take two of Wiley Intermediate Accounting. If you're on the 18th edition, it's problem 22-5. If you're on the 17th edition, it's problem 23-5. One of my viewers asked me to do this, and now I understand why. Textbook authors are Don Kiso, Jerry Weingen, and Terry Warfield. The question used in the presentation is copyright 2019 by John Wiley and Sons. All rights are reserved. This is copyright. This solution presentation is copyright Bennett Tchaikovsky, all rights reserved. These are my opinions and not the authors of the textbook or of Wiley. So let's go through and talk about what we're going to go through and have fun with today. So when we are going through and dealing with the statement of cash flows, what we're trying to go through and to do is to figure out what happened to my cash balance. Well, it was at 298 and it got down to 277. So there was a decrease of 20,100. So what I'm trying to go through and do is to basically figure out what caused this decrease. So the first thing I want to go through and do when I'm doing a cash flow question is I want to set up the statement, which I call the skeleton. I do have a lot of other videos where I do many more simplistic questions. But if you're looking, that's what I would do first, is I would basically set it up. So what we're trying to do is to see what goes into operating, investing, and financing. The best way to look at cash flow is to really kind of see, well, what's in investing and financing and what is in everything else. Financing is that if I buy my own stock, if I sell my own stock, if I sell bonds, if I redeem bonds, and if I pay cash dividends, those will all go into financing. Investing, buy or sell equipment, patents, those kinds of things. Operating is pretty much going to be everything else. So as we look at this over here on the question itself, you'll see this increase or decrease. I don't like to do cash flows that way. I like to go through and set up T accounts. When you set up the T accounts, you put in the beginning and the ending balance in each one. I've already done this here because this is the second time I'm going through and doing this question. So this is what we'll kind of go through and do today. Basically for this question right here. And let's get to it. So the first thing we're going to go through and do is we're basically going to look at, we're going to go through and look at the additional information first before we start going through and analyzing the individual accounts. So on April 1st, the existing deficit, and we see this here, was written off against additional paid-in capital by reducing the stated value of the no-par stock. And then it tells us on November 1st, 29,600 shares of no-par stock were sold for $257. The board of directors voted to regard $5 per share of stated capital. I'm doing these kind of simultaneously just because this is a pretty crazy question. So let's kind of go through and digest this. On the information, when we look at an account like retained earnings, right, what you have over here is it's going to have a beginning balance, right? For in our case here, it had a deficit of 450 and we have an ending balance of 20. What increases retained earnings? Well, we've got net income. What was our net income? Well, we had net income in the first quarter of 2025 of 25,000, and then we had 90,000. So we had a total net income of 115,000. I'm going to show a net income is going to be increasing my retained earnings. So I'm going to go through and show that as a credit. I'm going to come over here to my operating section, net income. I'm doing the opposite to cash in this particular instance. So I'm going to show this over here as a debit. Right now, as we go through over here and look at this, we say that, so it's something about this existing deficit being written off. But what I want to do first, though, is I want to look at, because I don't really know what that is. Let's look at this next one. On November 1st, 2025, 29,000 shares of no par stock. Again, never would see this in my entire time of practicing, were sold for $257. So we've got 29,600 shares. were sold for a total of $257,000. The board of directors voted to regard $5 per share as stated capital. So when I take 29.6 and I get this stated capital here of 5, this is going to be about what I'm going to allocate to the no par stock. Again, I have never seen this in my 30 years of practice. So if you find a company that has no par stock, I would love for you to share that with me. So now, but we sold this for a total of $257,000. That's what it tells us in problem 2. So for this one here, the difference between the 148 and the 257 happens to be 109,000, right? Where is that coming from? Well, it's the additional paid in capital common stock. So what we're going to go through and do is we have this common stock, no par, and we're going to show this as an increase of 148 because when we issue stock, we're basically debiting cash, we're crediting common stock, no par, we're crediting additional paid in capital common stock. This is basically being for 257. This is for 148, and this is for 109. So over here, 109,000. Under the financing section, we're going to say sale of no par stock. And this is going to be over here, the 148 plus the 109 or 257. This is an increase to my financing activities right over here at 257. And this is where this number is coming from, right? It's the 148 plus the 109 is giving us the 257. Now, one of the weird things here is it basically said it was a transfer of paid in capital, right? So I've never seen something like this before. I might just be, a little slow. I don't know what's going on with me, but I've never seen it. So over here, I would also, if your instructor is doing this question and they happen to be a PhD, ask them to show you a publicly traded company where this happens, and it may be Fantasyland. So coming over here, when we look at this T account, we started with 1,453,200. We added in the 148 for the stock we just sold, or 1,601,200. This does not equal the ending balance. There's a difference here of 425. If I look at this particular question, it says the transfer from the paid in capital balance of 425. So apparently what they went through and did was they basically said, okay, we're going to basically debit retained earnings for 425. And then we're going to go ahead. So we're going to credit retained earnings for 425. And then we're going to go ahead over here on the no par stock. We're going to go ahead and debit this for 425. If I debit this part over here for 425, the account balances, right? So I balance this out. Now, in terms of going through, and this has no effect on cash, right? It's basically you're crediting retained earnings, you're debiting common stock, no par. So what I would do over here under the non-cash transactions of the cash flow, I would say was written off against paid by credit by reducing the stated by 425,000. So it's a non-cash transaction. We don't put it into the cash T account, but we do have to disclose it. Now, as we're at retained earnings, as I look at this over here, my retained earnings account does not balance. It's off by 90 grand. Why is it off by 90,000? Well, over here, I declared a dividend, right? So this was given to me in the question. It's like the statement of retained earnings. I declared a dividend, right? So with this dividend that was gone through and had been declared, how would we handle this? Well, when I pay a dividend, I'm debiting dividends, crediting dividends payable, and this over here would be for 70,000. What happens to dividends? It gets closed out to retained earnings. Now for over here, I would debit retained earnings. This is for the amount of the dividend, but I also need to credit dividends payable. Now, what you notice over here is that there was no cash in this transaction. Generally, I have to go through every time I'm putting something in here. I have to find a way to go through and to balance this out. So I'm crediting dividends payable for the 70, debiting retained earnings. Similar to the other ones, basically what we would probably want to do is a dividend was declared in 2025 for 70,000. That will be paid in January 2026. So we would want to just kind of make some kind of acknowledgement. When I'm going through and using the T accounts, ultimately I have to go through and balance all of these accounts through. So that's what I'm trying to ultimately go through and to do. Okay. So we've dealt with now these first two, as well as the retained earnings fund. So when I come over here, I've got those two down. Next one, a patent was purchased for 15 grand. How would I have recorded this? I would have debited patents over here, right, for 15,000. I paid cash for it. This is going to be in the investing section. Okay, so this is going to be a credit. It's going to show as a negative balance on the statement of cash flows. So over here, so I've dealt with the patent. Now, when I sell equipment, what I need to go through and do is I want to use this journal entry, which I've already created for me from the last problem we just did. So what I do is that it said during the year, machinery that had a cost basis of 16.4 and on which there was accumulated depreciation of 5,200 was sold for 9,000. So I'm selling it for 9 grand cash. The accumulated depreciation was 5,200 and it had a cost basis of 16.4. If you ever want to memorize a journal entry, this is the one you want to memorize right over here. We enter the cash received, accumulated depreciation, the gain or loss automatically calculates itself. This equipment had a carrying value on my books of 11.2. Well, meaning that the net book value was the machinery minus the accumulated depreciation. I'm selling it for 9. That means I lost money. Or to balance this equation out, I have to get 16.4 on both sides. Where do these items go? Well, for the basically over here with the machinery, what I'm going to go ahead and do is I'm going to show a credit over here for 16.4. I also have accumulated depreciation on the machine. This is a contra asset account. So to get rid of it, I'm going to go ahead and debit the accumulated depreciation on the machinery. For the cash proceeds I receive, this is basically going to be over here in investing, sale of equipment. This is going to show as 9,000. The loss on the sale of equipment is going to go in the operating section. So my loss on sale of equipment is going to be a debit to the operating section. Now you might be saying, dude, why are you doing this? Because in this cash, the loss is already included in the net income. And basically, if I don't add it back, because this sale amount already kind of includes the amount of the loss, if I don't add it back, I'm not going to balance. Again, if you follow this methodology, you'll be in pretty good shape. Okay, so let's go to reason 1 why I'm going through and redoing this video. So here's the 12% bond for this question. So the 12% 20-year bonds were dated and issued on January 1st, 2023. The interest was payable on June 30th and December 31st. These bonds were originally sold at 106. These bonds were redeemed at 100.9 plus accrued interest on March 31st, 2025. So what we want to do first is that this balance here is as of 1/1/25, or excuse me, 1/1/25, right? If you're on the other book, it's going to be 1/1/20. So ultimately, we're going to have to get rid of these items over here and basically go through and try to go through and figure out something with them. So when we look at this over here, these are 20-year bonds that pay interest semi-annually. Let's take a look at what happened when these bonds were originally issued. So the amount when the bonds were originally issued, they were sold at 106 or 106% of the face value. So if the bonds were sold at 106, that means we initially had a premium on the bonds for 6,000. So how would this premium be amortized? Well, it tells us in the question, it says we're amortizing this straight line. So when we have this premium, it's going to be amortized over the number of the periods of the bond. If it's a 20-year bond, if we're paying interest twice per year, I'm going to have a total of 40 interest payments. Okay. So if I have 40 interest payments, it means that I'm amortizing this premium every time I pay interest by 150. Now, it tells us we redeem the bonds at 100.9 plus accrued interest. Now, what I need to do, though, is this is really not the premium on the bond payable when it was redeemed. What happened before the bond was redeemed is I had to pay cash for interest. I had interest expense, and I'm crediting cash. The amount I would be going through and crediting cash for is going to be the face value at 12%, right? So I paid 12,000 annually for interest, right? However, I'm just paying interest every 6 months. This is annual interest. So the semi-annual interest is going to be at 6,000. However, in this particular question, I'm basically redeeming them on March 31st, 2025. So interest paid on June 30th and December 31st. So I need to multiply this again by 0.5 or 1/125 to 3/31/25, or for a total of 3,000. So I'm going to pay them out $3,000 cash as part of the accrued interest. Now, when I go through and amortize this, my premium on bond payable. So this is 150 every 6 months. So over here for the premium, it's at 150 for every 6 months, but I'm more interested in 1/125 to 3/31/25 or 0.5. So I'm going to multiply this through, and this is going to give me 75. So over here, my premium amortization is basically going to be at 75. So my interest expense is going to be at 2,925. So my premium on bond payable, and this is very important to do this, on 3/31/25, this was amortized by another 75. So my actual amount and my premium on bond payable account was not 2,400, rather it is going to be 2,325. Okay, so I've got this part over here. So now what I need to go through and do is to say, all right, so I've got this premium, how do I basically redeem this bond, right? So over here, the cash I'm going through and paying to redeem the bond, when it says 100.9, so 106, 100.9 means it's going to be 100,000, right, times 1.009, or 100,900. It's basically just less than 1%. So that's how much cash I'm going through and paying to redeem the bond. I have over here my bond payable. I'm taking this off of my books because it's being redeemed. I also have to get rid of the premium on bond payable. So over here, this is going to be 23.25. Now, when I look at this over here, basically I'm now going to have a gain on redemption. My gain on redemption, why is it a gain? Because I need a credit to balance, right? So my gain on bond redemption is going to be the difference between these two amounts, or 1,425. So the way I'm going to go through and input this onto my statement of cash flows. So the way I'm going to go through and do this is I'm going to come over here to basically, I'm going to have for my bond discount, right? So hold on. Okay, my bond premium. Okay, so we had this 75 here, and then we have the 23.25, which is making this going down to 0. I also have over here my bond payable of 100,000, which is making this go down to 0. When I look at this premium on bond payable, I'm basically going to put this up in the operating section, because this is what I had to go through and do when I was going through and paying that accrued interest. If I don't account for this, I'm not going to balance. Down over here, I'm going to have repurchase a bond. My repurchase of my bond is going to be at 100,900 credit. And then I'm also going to have a gain on bond redemption. My gain on the bond redemption will be right over here at 1425. Okay. So again, when we have this bond being redeemed, basically we're going to show the cash proceeds basically from the financing, or the cash we're paying out of the financing. We're then going to basically show in the operating, any kind of gain will show up as a credit. We also have to deal with this amortization of the bond premium. Remember, our goal is for these different ones is we want to get these balances down to where they need to be. And that's how we're going through and dealing with this. So let's now jump over here to, we dealt with 4 and 5. Let's go next to the next fun one, which is right over here at number 6. The 8% 40-year bonds were dated January 1st, 2025, were sold on March 31st at 97 plus accrued interest. Interest is payable semi-annually on June 30th and on December 31st. So let's go ahead and take a look at this one. As you can see, I was already having fun with this before you got here. So, or this is my second take. Okay, so our bond payable, basically right over here, the bond discount had a balance over here of 4502. So let's take a look at this. So this is our 8% bond. Okay, so let's kind of pack this. Let's just depack this thing. So the 8% 40-year bonds were dated January 1st, but they were sold on March 31st at 97 plus accrued interest. So we have a bond that's being issued in between interest dates. So what we're going to have to go through and figure out is, well, the bond was issued at 125 plus accrued interest. So let's not deal with the accrued interest for right now, but let's try to go through and figure out, like, what do we do? How much cash did we get for this bond? Well, we got 125,000, and we got this at night. We basically got it at 97. So it was at 97% of the stated value, right? So this is going to give us a discount over here of 3,750. Now it tells us also that the expense of the issuance was 839, right? So there was a cost of issuance for an additional 839. So the actual cash proceeds we would have actually received would have been 120,000 for 11. And okay. So this is basically the bond issuance costs. Now, if we look at this over here, if we take 839 plus the amount of the discount, we get 4589, right? Our bond issuance over here is at 4502, right? So we have to kind of figure out what's going on with this part of it. Well, if I take basically the 4589, which is the total amount of the bond issuance with the discount, I need to go over here and look at something. These were 40-year bonds that were basically sold and paying interest semi-annually. So if we have 40-year bonds, and if we have 12 months each year, we're going to have a total over here of 480 months total. However, when it comes to amortizing the bond discount, basically we're not going to amortize 3 of these months. Why not? Because these bonds were issued. These were not outstanding from 1/1/25 to 3/31/25. So these are going to be my months to amortize. So if I come over here and I say 4589 at 477, my monthly amortization is going to be 9.62. So again, what I'm trying to go through and figure out here is I've got a balance of 4502. I need to understand where is that balance coming from, because when I went through and did this, this is 97% of face value, right over here, or the 3750, and then I've got an 839 bond issuance cost. So my total amount of my bond discount when it was initially issued was 4589. But this balance as of December 31st is showing a balance of 4502. So I want to understand where this is coming from. Well, if I take the amount of the discount amount, the months outstanding, I'm going to get 9.62. This is my monthly amortization. During 2025 or 2020, it was outstanding for 9 months. Or from 3/31/25 to 12/31/25. If I multiply 9.862 times 9, I'm going to get 8658, which if you subtract these two amounts over here, you're getting to the 87. So what you're going to see here over here is for the bond discount and issuance cost, the initial amount is going to be 4589. And then we're going to have this 87 here to get us to the 4502. Let's put this into a journal entry. The cash proceeds we are going to be going through and receiving, and we don't need to really worry about the accrued interest because it came in and got paid out. So over here, the cash proceeds I'm getting are going to be 124.11. I'm going to show a credit to bonds payable over here of 125. And then my bond discount, which will be a debit of 4589. When I add these two amounts up, I get to 125. So let's go through and put that in first, right? So my bond payable over here at the 8% is going to show a credit here for 125. My discount on bond payable is going to initially show over here of 4589. Now over here in the financing, because that's where we do sale of bond, this is going to show cash proceeds coming in at 124.11. Now, when it comes to this part over here, I've got this other balance here that I have to go through and deal with. which is on the bond amortization, because 4589 does not equal 4502. So over here, what this difference is, or this 87, I'm going to basically show this amortization of bond discount. I'm going to do the opposite to cash. I'm going to show this over here at 87. Does this work? I have no idea. We'll find out soon when we balance cash. Because remember, the change in cash has to equal 20,100. So we've dealt with these two over here. Okay. So Alexander Corporation acquired 70% control of Crimson for 100,000, right? So this is basically, you're now going through and consolidating. The income statement of Crimson shows a net income of 15,000. So let's take a look at what we went through and did with this one. So if we look at Crimson, or basically the investment in Subsidiary, okay, so we spent 100,000 buying this investment. We would debit investment in Subsidiary and we would be crediting cash. So this is going to go into our investing section. I'm just going to add another line. We're going to go into investing, investment in sub. And this is going to show as a credit. I'm doing the opposite to cash for 100,000. Okay. Now, when it comes to the other amount, or basically when it comes to, just give me a moment. Okay. So I've got now, so I know that I paid cash for this, right? So where is this other amount coming from? Well, if we take 15,000 and we multiply that by 70%, we're going to get 10,500. Now, when it comes to this 10,500, this is something that it's not really giving us, it's included in net income, but it's not giving us any type of cash. So we're going to go through over here and show this as income in Subsidiary. And we're going to show this as a credit. We're going to do the opposite to cash, or 10,500. Now, if this was actually, if we got a dividend from the Subsidiary, right, we would show this as a credit, and then we would be debiting cash in the operating section basically for the dividend. So in this case, when they're reporting income, this is included in our net income, but it's not giving us a cash. And so that's why we're taking it out. Let's go to the next one over here. So major repairs to buildings were charged to accumulated depreciation on buildings. Wow. Does that mean I debited cash and then credited? Hold on. I've never seen something worded this way, so I'm just going to kind of go through and look at what was basically in the books. So let's just go through and take a look at this. So it says that major repairs to buildings of 7,200 were charged to accumulated depreciation on buildings. So I'm assuming what this means is that we debited accumulated depreciation on buildings, and you would have credited cash. And because it relates to repairs on buildings, you would probably, because the repairs are significant, what you would go through and do is you would show this in investing. And this would show up here as 7,200. So that's how you would deal with the additional information on that one. That to me is just bizarre because you probably should have debited the building itself. And then because the accumulated depreciation, that doesn't make sense that you would go through and debit that. Okay, so coming back over here, interest paid in 2025 was 10.5 and income taxes paid were 34,000. So what we're just going to go ahead and do is we're just going to copy this over here and put this into our basically supplemental disclosures. You would basically put these parts over here. Okay, so now comes the fun part. So we've dealt with the additional information first. Now what we need to go through and do is to balance the remaining accounts. So what we're going to do is we're going to basically say over here for AR, to get this account to balance, I need 116,424 debit. I'm going to do the opposite to cash. And because accounts receivable is an asset, it's increase with a debit, decrease with a credit. There's going to be an increase in accounts receivable. Inventory went from 741.7 to 610. There's going to be an increase in inventory. I'm going to do the opposite to cash. I'm going to go over here and credit cash. Prepaid expenses, right over here. I'm basically balancing my T accounts. I need a 4,000 debit. I'm going to show over here as a credit to cash of $4,000. This is going to be an increase in prepaid expenses. Remember, if we're going through here and we have a T account, right? This is why I like using T accounts. Over here, we basically have assets equals liabilities plus owner's equity, ER, DC. We generally record assets with debits. They're increase with debits, decrease with credits. So when I'm describing it, because AR is increasing, that's what I do. Investment in subsidiary, this T account is balanced, right? We're now balancing all the T accounts. So over here, we've got 100,000, which we showed as the investment in sub, and then we took out the gain out of our operating cash. Cash surrender value of life insurance over here. This is going to be an increase of 504. Now, with this one in particular, this is going to go into investing because this is something, it's like an investment vehicle for companies. Increase in cash surrender value of the life insurance. This is going to show up over here as 504. Okay. With the machinery, what I'm trying to go through and to do is to go through and figure out what happened to this machinery account. How do I get this to balance? So to get from, if I'm over here, okay, so this is going to be 190,000 plus X minus 16,400 equals 207. So another way we can write this is 190,000 plus X equals 207 plus 16,400. So over here, this is going to be 207 plus 16,400 minus 190. So this is going to be 33,400. So we're going to show this here as a credit, and we're going to call this a purchase of machinery for 33,400. Buildings basically went from 535 to 407. This is going to be a purchase of buildings, or they call it in the solution is addition to buildings. It's fine. Patents, right? In addition to this one over here, let's take a look to make sure I have this right. Okay. So the problem with this one here is that I'm not balanced because 64 plus 15 does not equal 69. So I'm going to have to assume that I went through and I had a sale of a patent for 10 grand. Okay. So over here, and this is not in the solution to the book, but I don't know another way to go through and to have this balance. So we'll see what happens. Copyrights went from 50 to 40. So over here, I basically had over here a sale of a copyright. Oh, wait a second. I know what okay, so I screwed this up. This is not, okay. This is amortization expense. So sorry about that. So this is patent amortization. This is copyright amortization. When I do this in my classes, I typically will have an account called accumulated amortization, patents, and copyrights. So what this is going to be, this is basically amortization expense. Okay, and this is going to be 10,000 for the patent, and this will be 10,000 for the copyright. Let's talk about this for a second. When I amortize a patent or a copyright, right? And if we look at any company, when it comes to any type of depreciation, amortization, or the like, what you're going to see happen on the cash flow is you see the depreciation and amortization. When we prepare the cash flow, that you're showing this as an add back. So the depreciation and amortization is basically being added back. When it comes to amortizing your intangibles, you have one of two options. You can say amortization expense, and you can do accumulated amortization patent. Or what you can do is amortization expense, and then you just go hit the patent directly. So that's what they chose to go through and do. I like using the amortization so I can track it better, but that's what that relates to. Okay. Okay, so we balance there. The bond discount, we've dealt with that. The income taxes payable is going to be, this is going to be an increase in IT payable. This is going to be 10,650. We're doing the opposite to cash. It's a liability, so it's going to show as an increase. Over here, my accounts payable are increasing by $19,280, right? So I need a credit to balance. This is going to be a debit because it's a liability. That's what's happening. Dividends payable, bonds payable, bonds payable. We've balanced all those out. And this is why it's so important for you as you're going through and doing this, that you're basically kind of going through and basically making sure you're reconciling. So, okay. So what's kind of funny on this one is that with the allowance for doubtful accounts, they're showing that you've got a 4,700 debit. And this is usually with the allowance for doubtful accounts. This is what you would be showing, is you would normally kind of say that this would be bad debt expense. That's what I would usually call it. However, in this case over here, what they're doing is they're going through and combining it. So what you'll see is that, well, in order for me to go through, and I'd have to do the opposite to cash. So we're just going to call this decrease. Actually, this is just so poorly worded, plus ADA. So the 116,424, this is going to be 116,424 plus 4,700. So we're going to basically over here plus or 121, 124. And we're going to call this an increase in AR net. Okay, this is just a really poorly set up question. That is, to me, it's messed up, but it's just different than the way I usually go through and do things. Now, for this one over here, to balance this, I'm going to need an entry for 31,200. So what this is going to be building depreciation of 31,200. And this is why it's really important when you sell or you have this crazy stuff happening, like when they did that addition, you just got to make sure you're keeping track of it. The machinery is going to be 48,200. Make sure you check your work, right? If I'm coming through here and saying, oh, 400,000 plus 31,200 minus 7,200, that's got to equal 424. Just make sure you're checking your work as you're going through and doing this, right? That's what you want to go through and do. So we've got over here, machinery, depreciation. This is going to be a debit for 48.2. Remember, I'm doing the opposite to cash. You never call this an increase in accumulated depreciation. That's wrong. You want to call it what it is. Premium on bond payable. I dealt with this one when I redeemed it, and then I put this 75 up here for the amortization of the bond premium. So I've gone through and done all these other things. And now what I'm ready to go through and do is I'm going to go through and add things up. So on my massive T account, what I'm going to go through and do right over here is I'm going to be adding up my debits and my credits. When I add up my debits and my credits, I've got total debits over here of 246,617. I have credits of 288,824. 268,824. I go through and say, this is a total cash used in operating. It's going to be a negative number, right? Remember, I'm adding up each one of these sections. And what I'm trying to go through and get to is the 20,100. So now I'm going to go ahead and add up these balances over here. So this is going to be cash used in financing activities of 274,404. And then lastly, in financing, we've got over here $276,511. When I add up 276, and this is cash provided by, right? If it's positive, it's provided by, negative, it's used in. If this is your first time doing cash flows, this is not the question you want to review. You want to build up to this. This is very, very nasty. And wow, we got it to balance. But by the way, everybody, I was totally looking at the solutions as I was going through and doing this because I didn't want to do this a third time. But if there's a particular part you want me to go back over and through, feel free to put it down below. Okay, so to make the actual statement itself, if I've gone through and I've set this up correctly, and it's really by going through and doing this, right? So if I've set this up correctly, what I'm going to do is I'll basically cash flows from operating activities. I'm going to start with net income. And what I'm essentially doing is that if it's a debit, I'm going to show as a positive amount. If it is a credit, I'm going to show it as a negative amount. So we can do ourselves a little favor. And we need more room. It's fine. Okay, so over here, we're just basically copying over from our big cash T account. And this is obviously a lot easier to do on Microsoft Excel than to go through and handwrite this out. If you actually have an instructor that's going to give you something like this on your final, that's actually kind of impressive. This is absolutely brutal. I mean, you're seeing me going through and struggling with this, and I've been doing this. I've been doing cash flow questions for a long time. I can't imagine what you're going through, but hopefully this helps. Okay, so right over here for investing, what we're going to go through and do, we're just going to give ourselves some more room. Okay, so again, when it's coming over here, if it is a credit on the T account, I'm going to show this over here as a negative amount on the cash flow. And because the amount is a credit, this is going to be total cash used in investing activities. 274,404. Cash from financing, sale of no par stock, repurchase of a bond, sale of a bond. This is going to be a positive amount. This is going to be a negative amount. This will be a positive amount. And so this is because the amount is going to be positive. We're going to say this is going to be total cash provided by financing activities. It's going to be 276. If I'm adding up these three different items, I'm going to get to 20,000. I'll get down to 20,100. I add that to my beginning cash balance. It gives me my ending cash balance. And over here, you've got just the other non-cash transactions or supplemental disclosures. And that would basically be supplemental disclosures, cash paid for interest, income taxes. And I'm throwing in the dividend over here just to basically kind of make that clear too, but it doesn't have that in the KESO solution. So I don't even know how long this video, but this actually may be a new record, but I want to thank you, thank Wiley, and thank my viewers out there for putting me through this torture. I'm just kidding. I actually enjoy doing this stuff. So in any event, if there's anything else you guys would like to go through and see, please feel free to go through and email me. Please don't forget to like and subscribe, and I look forward to seeing you on future videos. Have a great night.